and a warm welcome to today's institutional digital asset listeners, wherever you are around the globe. And thank you once again for taking the time out of your busy schedules to listen in. Hopefully today's podcast will bring you some great insights and value in return for your time. As the host of the Gspröch podcast, it is my aim to keep everyone engaged with great podcasts covering diverse subjects, primarily centered around the institutional adoption of digital assets. In previous podcasts, we have covered how regulation is driving innovation and adoption, particularly in the EU with MiCA and in Turkey with the new crypto regulations that were posted on the 2nd of July. How institutional tokenization is gearing up for the mainstream, and how a long and established Swiss bank in Luzerner Kantonalbank successfully entered into the digital asset space in the last 12 months. But what about a bank that's been into the digital asset space from the start? How did it build out, and how does it currently maintain its brand leadership position? Due to the relative immaturity of the digital asset sector, banks have up until now been able to position themselves as the more mature, solid and secure alternative to offerings from crypto native exchanges or brokers. But as markets are becoming increasingly regulated and competitive, which is a good thing, by the way, for the whole digital asset ecosystem, it's starting to become more difficult for banks to differentiate their crypto offerings. The question, if both offerings are regulated, how do you differentiate? Now, Bank Frick, with its head office in Liechtenstein, has been one of the earliest pioneers of digital asset banking, having launched its crypto services all the way back in 2018, which seems like a lifetime now in the digital asset and crypto sector. But over the past 2 years in particular, the bank has built on its early mover advantage by launching innovative new products and services that cater specifically for the needs of its digital asset client base, therefore solidifying its position as an innovative product leader in the digital asset sector. We are therefore really pleased to welcome Jonas Gantenbein, Head of Digital Assets at Bank Frick, as our guest for today's podcast. Jonas has kindly agreed to share his experiences in developing and driving the fundamental decisions behind Bank Frick's leading digital asset product strategy. So Jonas, congratulations, by the way, to the whole Bank Frick team for achieving its 25th anniversary. You guys have just about beaten me to my 25th wedding anniversary. So let's kick off with an easy one by you giving an intro to yourself and what you and the awesome team at Bank Frick does for its clients. So welcome, Jonas, and over to you.
Thank you very much, Stu. Thanks for having me. It's great to be here. Well, as you mentioned, Bank Frick, in the context of a banking company, is a very young company, but we have been venturing into the crypto space or the blockchain space from very early on, back in 2017-16. And my role at Bank Frick currently is to head the digital assets department, where we mainly focus on DLT systems integrations, but also think a lot about DLT innovation management, how to provide new products, innovative products that actually serve a purpose and actually solve real-world problems our customers have.
That's great. I mean, thank you very much for that. We look forward to understanding all of the developments that you have, and maybe some that you may or may not be able to share your insights from about what that future roadmap is. But we'll come on to that a little bit later. But why don't we actually start off by going backwards a little bit, right? Why maybe you could start off by perhaps providing some context and background into Bank Frick's actual decision to move into digital asset offerings in the first place. As the first bank in Europe to make such a move back in 2018, what were those key drivers or performance indicators that were really behind the decision?
Well, I think the legend varies a bit depending on who you ask. But the fact is, there were a group of core people that realized very early on the potentials of blockchain technology and Bitcoin, for that matter, and became very engaged with the idea to build upon that. But to give a bit of context, Bank Frick, being such a young company and sort of always catered to niche markets originally for intermediaries in and surrounding Liechtenstein, we always felt the need, being such a small company, to go into niches and also be very innovative and agile when it comes to new products and new developments. So that was sort of the backbone that supported the idea going into blockchain itself. And also, I think it is worth mentioning that we are fully family owned, meaning by one family, one shareholder, which allowed us to essentially have a long-term vision, or establish a long-term vision on what we try to achieve with blockchain and the whole DLT space. And essentially that gave us then also the power to stick onto it, because as we have seen, there are bull markets, but there are also bear markets, and in bear markets then can be quite long. It is can be hard in financial institutions to get the support from the upper echelons. So I think it was a combination of a couple of visionaries, a good backing from the shareholders, a C-level management team that sort of acted as enablers, which ultimately drove us in becoming a bank that provides traditional services, banking services, fiat accounts, fiat gateways, for example, for crypto companies back in 2016. And from that on, we slowly but surely developed other DLT-based products as well.
Absolutely. And now you are based in Liechtenstein, and everybody talks about MiCA and different jurisdictions bringing out new regulation for for regulating digital assets and digital asset infrastructure and digital assets products and services. Obviously, previous to that, we had obviously in 2021 we had the DLT and Blockchain Act here in Switzerland, but around the decision to go to market around 2018, was there a sort of a regulatory environment or an environment in Liechtenstein that was also a factor behind giving the confidence to Bank Frick to enter into this market?
There was no regulatory framework outside the traditional banking frameworks we had at the time. And that was one of the main, I'd say, challenges to overcome very early on. I think the mindset of having to be innovative applies also to Liechtenstein, since it, compared to other countries, is very, very small also. So we sort of felt the support from our regulators in the sense that they were keen to drive innovation as well, and they were very open for discussions and really tried very early on to understand what moving into a blockchain space for a bank entails exactly, and where the funds are coming from and what the mechanisms, the underlying mechanisms are. So that was essentially our enabler on a regulatory level, with a very good communication line with our regulator to move into the field in the first place.
And that's always really important, to have that open dialogue with the regulator, and also being able to, not influence, but to provide information that actually drives, innovation in a particular country or in a jurisdiction. So other than sort of regulation hurdles to overcome, what would you say were the other maybe 1, 2, or 3 main challenges that you encountered at the bank in really getting your digital asset products and services off the ground and finding, I suppose, that PMF, that product market fit?
Yeah, well, sort of the PMF found itself through trial and error, because you had no peers to compare yourself to, or essentially, I think when talking 2017-16, when we started to provide classical banking services to crypto natives, it was largely focused on how we could enable those customers while being regulatory compliant in the meantime. So a lot of questions evolved around KYC and due diligence, and us really understanding the business models of our clients, and understanding where the funds are coming from through mining, for example, or different mechanisms. And so it was a compliance issue, but also it involved a lot of communications, as I mentioned, to regulators, but also to correspondent bank networks, because we were heavily reliant, for example, in the USD correspondent banking rails sector, that we are compliant and adhere to the rules and regulations of those networks, since crypto transfers, being associated with crypto either through a name or really a crypto transfer in the end, those were ultimately high risk from the get-go. So we, in Liechtenstein, we have the risk-based approach when it comes to due diligence and KYC, and those transactions and those those relationships were essentially high-risk relationships. So we had to find a way to really understand and go the extra mile, gold plate essentially our KYC regulations in order to be extra sure that we have a sustainable business model. And that ultimately led also to a rate of declining customers in the ICO boom, for example, which was above 90%. So we only took in about 8% of or so customers that applied for for products with us.
That's a very interesting point. So maybe, if you distilled it into maybe one or two areas that, if you look back and said, actually, what would we have done differently with what we know today, it's always the benefits of hindsight, what would we have done differently or not done at all if we look back at 2018? Are there any sort of insights that you've driven as a bank and conclusions on that?
Well, yes, I think a second area of difficulty we encountered very early on was also when trying to think about DLT services, custody, tokenization, all those services that are DLT based. There was essentially no infrastructure or no institutional grade infrastructure out there in the markets we could use. So being a small bank, we never really played with the idea to build something our own. So we don't host our own nodes. But we always relied on third-party software on that. And still we had to find a way to be somewhat extra sure, make sure our clients' deposits and assets are extra safe when handling crypto. And in hindsight, it is very easy to pick winners and losers. We know in hindsight which partners and infrastructure were the winners in the end, but that was not so clear back then. I think it would be very hard putting myself in the shoes of 2018, 19 again, 2020 even, to do things differently. It was trial and error based. What I can say is one of the great challenges that came along, well, it's a good challenge to have, but still, nonetheless, it was a challenge, is the exponential growth we experienced through going into the blockchain market. Not only in the blockchain banking division, but all the other divisions were affected by it as well. And that growth essentially pushed us towards, being at the size where the old structures, the old processes, the old frameworks we had in place were not robust and were not good enough anymore in order to make things scalable. So I think what I would have done differently is to anticipate earlier the growth and anticipate more growth in order just to be ready. The American approach, hope for the best, prepare for the worst, essentially. That would have allowed us more easily to focus our resources on development and not in parallel building structures that are sufficient for the size we have now.
Yeah, that's a great insight, and I'm sure a lot of our listeners today would take some of those experiences on board if they've been through that. And for for people and institutions who are thinking about going into the space, I think there's some very wise words there. So thank you very much. Now, we talked about Bank Frick being an innovative pioneer from the early days of institutional digital asset products and services. So you've been really well positioned to be able to experiment in different product developments, and because you've been at the bleeding edge of digital asset banking, you've had I wouldn't say the total luxury of time, but almost the luxury of time in compared to peers in the market to be able to ideate and test, gain feedback and all of that feedback loop as well. So maybe if we can start to focus on some of the more recent product developments and offerings, and we can maybe kick off by, if you could explain to us and to listeners today around the staking as a service and how that works for you and your customer base.
Gladly to. I think when speaking about staking, you have to come from the fact that it is all based on custody in the end. It is sort of a natural progression to the custody offering we had for a long time now. And we treated it as such. We've been playing, or we have been thinking about staking and testing staking since the early 2020s. Also because there was, the big polar star Ethereum transitioning to proof of stake, and we wanted to be ready as soon as this transition has happened. So we essentially were always expecting and still expect that staking within generating yield on top of your crypto holdings will somewhat cannibalize the custody-only business, obviously for proof of stake coins, that is. And we, as I said, we treated it as a natural progression. What we do is we do manage the keys at Bank Frick level. We have, custody is a whole different section on its own. We have built, safeguarding mechanisms and governance structures and processes and insurances and all that around our custody infrastructure. And essentially, we work with third-party providers that allow us to move the stake of our customers into validation smart contracts through third-party providers, as I mentioned. And I think it's very important to note that for us, in institutional grade manner, it was always very important that the security, the protection of assets comes first. So we only work with institutional grade providers on custody, but also on validation service provider level. We have extensive business continuity management. We are prepared for each and every case that could be done, defaulting scenarios of service providers, etc. But also, it was very important always to state that the coins being staked or just in custody are always held off balance sheet. They are never staked for the benefit of Bank Frick. They are never rehypothecated or otherwise encumbered. And that was essentially what you see is what you get. And that was always very important because we cater to institutionals, to professionals with those services.
And that probably leads me nicely into another sort of point in question is that, you have different sort of client segments. What was the core sort of target market for staking as a service? And has that changed over time as the market has evolved?
While designing the service, we specifically had the institutionals in mind, the funds, the hedge funds, the ETP, ETN issuers, since they are those guys with the most set of requirements to have to be met in order to go into such a service. So they really were the critical path, and we, the whole security mechanisms, the fail safes, how we book, rewards and such is all specifically structured to meet their criteria. But nonetheless, we have different divisions, such as the classic banking arm with family offices, with wealth managers that not necessarily have to do with crypto on a daily basis. We have funds and capital markets customers. We have blockchain native customers, and also private clients to some extent. So we provide the staking service through all those divisions. But really, the framework has been built for the institutionals.
And with those institutions, if that was the main core target market, how much education and awareness generation did you have to do around staking compared to something like, okay, we hold your assets in custody and we maybe allow you to trade those assets in and out? Was there a lot of more education around staking?
There was education in terms of how it works with us, where the risks lie, where the benefits lie, how we do things, but not so much on what staking is as part of the consensus mechanism, for example. We have divisions such as the classic banking arm where we do more sort of thought leadership and more, knowledge transfer. But really, with the institutions we work today, they are very well prepared themselves.
Great. That's great to understand and to hear that. Now, from a personal perspective, I'm really excited about talking about the next product topic. And there's been a lot of development around the launch of Pulse, which is Bank Frick's payment service enabling, I think, near round the clock payment settlements. And effective settlement networks in fiat have really been held back, I think, the flow and interoperability of the market. But that's now changing, obviously, with Pulse and others. So could you maybe explain to the listeners today about how Pulse works?
Sure thing. I think it's best to come from the problem side, the problem the market has faced for quite some time. Since being sort of the fiat gateway for the bigger players in the industry, we realized very early on that there is a tremendous gap between the 9-to-5 operations we have here in our banking sector and the 24/7 nature of blockchain. And Pulse is essentially the answer to that. Pulse enables all of our customers. So if you're a customer, you are by default connected to our Pulse network. Pulse enables our customers to send and receive fiat between one another 24/7 on same currency and multi-currency basis. So FX could be a part if you as an institution need to FX capabilities on the weekends, that could be a part of it as well. The thing is, we haven't, we were not the first to do that, obviously, with Silvergate and Signature being a very big strongholds for their networks in the US. But what we've been, or let's put it differently, we encountered a huge influx of network participants after the default of Silvergate and Signature, which ultimately benefited us to a great extent. But because in a sense, the bigger the network, the more value it gets. And the more participants there are in there, the more flexibility you have with your fiat flows. What we've not done is yet, I'd say, what we've not done is building the Pulse on a blockchain, since we haven't seen the immediate need for that. But that might be subject to change in the future or in the near future, since you mentioned it, the interoperability piece could be quite enhanced through tokenization of fiat deposits, for example.
So, I mean, one of the points that you made around you were not the first to market with that, and there's always sometimes benefits in product development and product strategy and go to market of being first. No one's ever going to be first of a kind, truly, particularly the way that with Moore's law and increasing technology that drives the ability to react and innovate is always there. And obviously the biggest success story is, in that sort of never first to market is Apple, right? Apple were never first to market. Apple looked at the challenges where the failings were and said, we can do it better, right? And, we've had obviously the failings of Silvergate and Signature Bank. But that is obviously going to benefit the market from those learnings and from growing out of that. So what has been your client feedback to date in terms of, the product market fit and really maybe where you should be taking this in terms of increasing the ecosystem. As you said, the network effect grows adoption and therefore becomes more valuable over time.
I think it's like Chris Dixon, the famous Silicon Valley venture capitalist, said, "Come for the tech, stay for the network." I think there is a lot of truth in that, in the sense of we've been blessed being in the space so early and build the extensive network of customers and clients that interact with each other anyways. We have those all under our own umbrella. In terms of moving further, I think settlement cross currencies, meaning settlement cross fiat and cryptocurrencies in an automated fashion, is the way to go. That also would allow the players that, for example, Signum and Amina have just launched their own respective networks, for example, that would allow the banking players that provide such networks to have more capabilities in terms of delivery and payment, for example, for trading. So there is, in my opinion, much more room to grow. But still, I think building networks is the hard part, not the technical aspect of it, but the amount of participants that are moving inside those networks. That is the hard part of it.
I totally agree with you. From our perspective of Wyden, we're not just the technology; we are also the network in the ecosystem. Not around the blockchain level, but around the whole trade lifecycle piece as well. So we understand completely, where you're coming from around, building the network, building the interoperability, and then enabling the ecosystem to grow, and then the value grows over time. So I completely understand that. Now, if I was a bank, for example, today, and, as we know that with regulation, there are a number of banks, particularly in the EU zone, going to market with offerings for their client bases, but particularly around retail, I think initially, and then more institutional second. That's been my understanding so far. So if I'm a bank just now starting out and thinking about how I can produce and bring to market regulated digital asset offerings, can you maybe share some insights into the process that you have in terms of product strategy development? And maybe as a second point to that question, what would you say would be some of the main differences that you've experienced from a product strategy, development, test, deploy perspective in compared to the traditional markets? Are there fundamental differences, or is it just it's a product, but the process is the same?
That's a very good question. I think when designing a digital assets offering, it is very likely that you need to have a more holistic view on what you're trying to achieve. For example, a fiduciary instrument is a fiduciary instrument. There are only so many things you can do with it. With Bitcoin, you would have to consider using Bitcoin as a store of value, or in terms of, do you want to provide just simple as is custody for it? Bitcoin could also be a sort of a means of settlement and transaction, right? And those two are completely different things with the same underlying. And depending on what you try to achieve, you would need to have a very clear understanding where you want to go in the future, in terms of how this product should evolve, in terms so that you can, prepare your system landscape and your structures and processes accordingly. Since Bitcoin as a store of value or Bitcoin as a means of payment, those are vastly different things. So this multifaceted aspect of digital assets and how they can be used, I think, is the main differentiator between traditional products and digital assets.
Yeah, I completely understand when people ask me who are not in our sector, what is crypto, what is Bitcoin, what is it, and is it a payment, is it an asset class? And I say, well, it's all of them, but it's not just that. It's a paradigm, it's a protocol, it's something that's not just a productization, it's actually an infrastructure. It's something for me that's completely unique, that actually sets it apart from oh, it's not equity, it's not FX, it's not fixed income, it's not derivatives, or it's not a Swift network or a fixed network. It's something that amalgamates all this together in order to provide immutable exchange of ownership.
Exactly right. And depending on who you talk with, it can take, almost biblical, proportions and be sort of a religion. So it's very, you have to have a nuanced understanding where you want to go with the digital assets in order to make a well-fitted, for your organization, well-fitted offering.
And just lastly on that point, you mentioned that let's just take a base case of, if we're going to develop a strategy around Bitcoin being a payment and settlement, or whether it's a store of value. Do you have any sort of ideas and thoughts at the bank from a kind of metrics or analytics perspective to help you understand where are the growth opportunities, even understanding the baseline of what the background to the thesis is from a product strategy perspective?
Well, it is to say that Bank Frick is exclusively execution only. So we do not do advisory. So that part I leave out and mention that we always came as being the venue of execution, always came from customer needs. So essentially, we realized that there was a problem our customers faced and tried to reverse engineer from that problem to a solution we then can provide.
That's, I think, the way it should be done personally. So I think that's great to actually ensure that you reverse engineer that. So maybe we could now today move on to the final topic for today's podcast. And could you perhaps maybe share some insights from your perspective to the listeners around potential future trends that you think or that would have some lasting impact on the digital asset market or even the development of the technology?
Well, if I would have Saruman's Palantir, I don't think I would be sitting in this office right now. But what I can say is that blockchain, since I dove into the rabbit hole, blockchain always struck me as a solution that is waiting for a problem. And our approach was always that we sort of put a very clear focus on the problems that the blockchain tech should solve. Of course, we thought about, or we investigated the ICO craze, the NFTs, the metaverses, but those trends always adhere to the casino aspect of blockchain, and we very much focused on the computer aspect, and how we can make processes more efficient, automate things, etc. So I think very obvious. I think no one listening to this podcast would disagree or would be surprised, but very obvious is payments in our field. That payments with a blockchain settled instantly without counterparty risks is a huge catalyst. Thinking of correspondent banking networks, for example, the liquidity that is being locked in order to post collateral and to establish trust between those banks, the amount is enormous, and that liquidity could be freed once and for all and put to use in different ways if we would have a means of settlement that does not require trust. Obviously, blockchain. The problem with that is that I don't see existing power structures to be broken down so fast. I think I'm a believer that it will happen in the future, but it won't happen overnight. Same with tokenization. I think tokenization has huge implications on how we do business, for example, in the securities market. But still, there are whole system landscapes the companies have invested billions into that need to be broken down first. And I don't see that happening overnight, but we see there are great efforts that are being made right now from the big boys in banking also, which make me being optimistic that a potential change moving more to blockchain for settlement could be coming soon.
Yeah, I completely agree. I mean, when we sort of people who've come over from the traditional asset industry, in the last sort of 10 years, and I think there's a mass wave that's moving over now. I think most people have been involved with, the bleeding edge of innovation on the TradFi side. We'll see, have always seen that there one day, there will be a coalescence back into, TradFi and digital assets coalescing, because at the end of the day, if you look at if you summarize it, distributed ledger technology is about the efficient interoperation of markets to actually transfer immutable ownership without having a T+2 and multiple counterparties in between. It just goes to be that there's also an asset class and payment and settlement element to it as well. As you said, the big boys, you will get resistance, but remember that the infrastructure in traditional assets has been really around since tabular computers came out in the early 1970s. And it hasn't really changed much since then. Swift networks, fixed protocols, payment systems, chaps. It's all been there and it works. So if it works, why change it? And there's a lot of vested interest in that. But I think with regulation and banks being innovative and regulation allow them to build products and services, there is definitely a case of why not tokenize equity when you can have immutable exchange of ownership and settlement without having a T+2 vapor trail behind you. It just doesn't make sense anymore, particularly where the exchange of information globally is so quick.
I totally agree. And ultimately, it comes down, in my opinion, to breaking down silos. And we've been very good in the past to building up silos in order to, especially in the banking landscape, in order to sort of establish artificial barriers of entry to protect its own business. But every business model is finite. And I believe banking business models are finite for quite some, or will be ending or are in the process of ending for quite some time now, because it's getting very expensive to run banks the old-fashioned way. But still, I think breaking down those silos is one of the key things we have to overcome first in order to use blockchain effectively. Thinking about, for example, how nice would it be take Liechtenstein, for example. It's granted a very small ecosystems, but it has per capita a lot of banks operating here in Liechtenstein, and a lot of those banks have the same customers, and each and every customer has to go through an onboarding with each and every bank he wants to engage with. Why not build a network that is Liechtenstein-wide on a blockchain that enables the customers for once to be in power or to be in charge of his own data, and use the banks, because you don't need to be verified with all the banks. You need to be verified once, and that would be it, right? The banks can use those data that is verified by another banking peer in order to have an onboarding light, for example. A regulator would have access to information stored on the blockchain automatically. That would be an efficiency gain for each and every party. But the breaking down silos is the hard part, especially because a lot of politics are involved as well. I think it ultimately comes down to power and clinging to power in the end, which why I think the transition won't be happening overnight, but I'm sure it will be happening.
Thank you. We're here to break down silos, not change politics effectively. We'll achieve neither on this podcast today, but I really appreciate, Jonas, for the comprehensive insights you provided today for our listeners, and how Bank Frick went to market, how it maintains its innovative leadership position in providing institutional digital asset solutions to its clients, and how it sees the market developing. So big thank you to you for taking the time out of your busy schedule today to support Wyden's Gspröch podcast series. And once again, thank you to our other podcast guests. You, the listener, are also the critical element in making the Gspröch truly successful. So please continue to listen to future podcasts. We are effectively booked up with great guests until the end of the year. So please continue to spread the good word so we can continue to grow our listener audience. Looking forward already to welcoming you all to the next podcast. And with that, enjoy the rest of your day, whatever time zone you are in.